Hi, welcome to Market Minute and happy Halloween. Did you see the Commanders and Bears game over the weekend? Incredible Hail Mary play by Daniels. That guy is phenomenal. We're expecting a correction to occur after the election. And if Trump wins, we think the theme should be focused on, small caps and mid caps, those type of stocks that have, depressed valuations that will really benefit from a pickup in the overall economy. We see a 50% move easily in the small cap space over a reasonable period of time. If Harris wins, we don't see much of a change. We'd be buy our bonds and we'd focus on the green energy space. So what generally happens after an election, you get a little bit pickup in the stock market, but we're not seeing it this time, in our opinion. Um, we think that with the Trump win, we think that the market will focus on maybe higher inflation, a little bit higher inflation, and higher growth. Therefore, bond yields will probably have a five handle on them potentially, rather than a four handle on them. And if you have a 5% yield on a 10-year treasury, that hurts the PE multiple quite a bit. So we're currently at 24 times this year's earnings, 21 times next year's earnings. And the fair value with a 5% 10-year treasury is more like 17. So we know that the AI stocks distort the overall valuation of the overall market. So maybe a 19 multiple on 2025 earnings is probably more appropriate. And I'll show you where we think the stock market's going based on that in a second. We do get Apple, Amazon, Google, and Meta this week, so those are important reports. I would have to say there's probably risk to the downside in all these stocks. And we just think that, generally speaking, that Apple on a secular basis is kind of running out of steam. They've kind of penetrated as much as the market, as much of the market as they can in a reasonable period of time. So we'd be most concerned about that one not necessarily falling, but not just performing well as maybe the other ones in the group and maybe the overall stock market, and would look to start to trim that back. So where are the opportunities in the market? So we like the growth and income type of stocks or the higher dividend paying stocks until the market has a big flush out. When the market pulls back quite a bit, the market becomes a little bit more interesting. There's more upside to it. But currently, we see if you can get a 6 to 8% yield on a portfolio of high quality dividend paying stocks or growth and income type of stocks, we think that's going to outperform until we get this big flush in the overall stock market. Maybe it doesn't occur, so that's a nice place to be. Like I mentioned, small cap, that looks great. We'd be buyer on the dip of small cap companies, the Russell 2000 in particular. This is the S&P 600 over here. So it's currently at about 15 times earnings. We think with the right policies in place that Trump wants to put through, we think that the small companies will trade above their high end, above the 20 times that they historically have been at. So you can see over this very long period of time, small caps do get to about 20 times or about 15 times currently. But what I find more interesting is a lot of the strategists don't like the Russell 2000 because of the companies there that don't pay dividends or that don't have earnings. Well, what's interesting is those companies that don't have earnings. So those will have big moves if we see this massive move in the small cap space. And a lot of those companies are biotech companies, and we really like the biotechnology space. So next year, looking at the next year, there's growth expectations for earnings of about 36% for small cap companies versus only 3% this year. And so we see a shift in leadership. This sector market is so small. I mean, it's smaller than Apple, right? A very little bit of money can move this sector in a big way. So if you get large amounts of money that get reallocated to small cap companies because the performance starts to get good, you could see a rip-roaring rally in these type of stocks. So the technicals on the S&P, we're a little bit concerned about it. We have been for a while. It just continues to roll higher. However, we get these, big extended moves and that we get a pullback like we did in July and August. So we think we're kind of we hit kind of the high end of that range of the channel, and we think if it breaks the 20-day, which is about 57.90, then we're probably going to have a little bit more downside or a correction to occur. We'd like the markets down around the SP 500, down around the 5,200 level. We really like it down here. Of course, always like it lower, right? But that's roughly 19 times earnings. A lot of companies that we would look at would be trading in the probably in the mid to lower, teens in terms of multiples at that point, which would be a great buying opportunity. Pick off some great dividends. So we would like to have a correction to occur for that opportunity. And reason why we're saying that is we think it's kind of set up to occur. If we get the 10-year Treasury to move higher, we're going to see a pretty big pullback in the overall market before, the big growth should occur, economic growth should occur. The small cap stocks on the biotech, okay, they're off the October low. They're up about 47% up off the October low. And that's a nice move, but it's just a start. We see one of these 2007 to 2015 sort of 4x type of returns in front of us. So when the group moves, it moves in a big way. It moves 100% at a time. So kind of in our mind, we're thinking, okay, we'll probably get at least 100% move out of this sector, but we think that there's things that happening in the group, really positive things that'll drive this group a lot higher over the long term. So we really like this part of the overall market. Small cap and small cap biotech, mid caps as well, and then the income and growth and income type of stocks. The election. So wouldn't it be really funny? It would be really nice to watch. It'd be worth watching all this rhetoric go on TV if the politicians had to wear a shot collar. And every time they lied, they get a zap. We think the Senate is going to go the Republican way. We think the House is going to be a coin toss. So it comes down to 3 seats in the House. That could swing it one way or the other. We think the polling numbers for Trump look really good. Probably Trump wins. And we think that's probably in the overall markets at this point. If Trump loses and Harris wins, then we think the market corrects, nicely. So we think there's a correction either way. Before on the election year itself, historically we've seen about a 6.7% return, and then after the election, oddly enough, you see about a 6.7% return, but you see a little pop generally after the election results occur. So. And if you look at this is kind of interesting. This is roughly 17 elections, and 9 of the 17 you've had a recession the year after the election. Some years you've had the recession occur during the election year, but 9 of 17, so over 50% of the time you have a recession after the election. We think that's pretty highly likely to occur this time because the government spending is going to slow down in a major way. And so we're expecting a more challenging market as we look out for the next 12 months, but there's really big opportunities in some sectors of the overall markets. The Beige Book. Okay, we talked about this last week. I really like the Beige Book. It gives you kind of an inside view of what's happening in those 12 U.S. Economic districts that the Federal Reserve surveys. So they do a survey of each of the districts around the country to see what the business trends, how they're shaping up. And this will be September report that's reported in that was reported last week in October. So the September trends were very similar to the August trends. So 5 of the sectors had negative growth, 3 flat, 4 saw growth. So it's roughly flattish, right? That'd be my view of it. That there's roughly just no growth at all occurring in the private sector of the overall economy. So it's different from the government, adding the government, and that's the private view. So quickly, the consumer spending was mixed. Banking saw a modest decline in loan demand. That kind of surprised us a little bit. Consumer credit quality was a little bit negative, so a little bit increasing to the negative side, but stable-ish in general. Real estate, no big change in what's going on there. Still, inventory levels are low. Manufacturing, okay, here's the thing that changed, and we think that this is kind of set up with the small cap companies as well, that we saw an improvement in the manufacturing sector for the first time in a long time. So expectations of holiday spending was pretty muted. Remember, um, Thanksgiving comes 5 days later this year, and so there's roughly 6 less shopping days. So it's hard to be too excited about consumer spending when there's 6 less shopping days this year. Um, the labor market continued to ease from being really tight, and then prices paid continue to go up modestly. So the Beige Book is not really exciting. I mean, it's just flat growth, not a whole lot going on, except for maybe an improvement in the manufacturing sector. The GDP now, so this is the Atlanta Fed. They put out these expectations of what's to be reported based on the reports that we've seen so far in the quarter. So they're looking for that 3.3% growth in the GDP this quarter. That doesn't match up with the flattish growth that we're seeing from the Beige Book, right? So we believe that that it's not, the Beige Book doesn't pick up the stimulus from federal government spending. So federal government spending is going to tail off in a big way after the election. What's happened is they basically are spending double what they did in previous quarters in the election quarter, or in the third quarter. So we think that's going to tail off quite a bit, and if the overall economy doesn't start to improve, with the government spending coming down, we're going to see maybe a negative GDP number in the fourth quarter or first quarter of next year. ANAVEX. So we really find this stock really interesting. So in our emerging healthcare strategy, we look for companies with 5 to 10x upside potential. We also put these into some of our other strategies as well to give an extra little boost to it when these things hit. But big upside potential in the stocks that we put into our emerging healthcare, and we don't put them in when the stocks are $25, $30 after a big move like this. We want to be down here when the expectations have been washed out of a stock for no good fundamental reason. Maybe some idiots have big losses in it. We like to come into it and had to sell it. We like to come down into it when the risk reward is really favorable. So they have 137 million in cash and a market cap of 457 million. So we think the downside is probably $2 or $3. The stock's at $5, and we think the upside is well above the historical range of what it was. So we think that there's 5 to 10x upside in this stock, and that might be a conservative estimate. So let me walk you through it. So the Alzheimer's sector, this is an Alzheimer's drug. It's a phase 2b/3. They've reported results. The results look really positive. And so it's oral, minimal side effects, nothing related to what you get on the antibodies from Lilly and Biogen. There's no brain hemorrhaging, no bleeding. You don't have to go get MRI'd. They don't have that big risk. It's not an amyloid plaque remover. So this is a drug that works in a different way. Very limited side effects. The side effects are very nominal. It doesn't relate at all to anything that seriously impact your health. So what's interesting is the European Medicines Agency in August rejected the Biogen drug. So Biogen and Lilly are not approved in Europe, right? the Europeans believe that there's too much risk around those drugs versus the little bit of improvement that you get from the from slowing of the memory decline. So this drug, I think, has nice potential to it. It's oral with no side effects in a big market that needs a solution. We think they filed this with the European Commission, and it's on their website, but I don't see any press release around it. It's public information, but the Wall Street doesn't know that this has occurred. I don't believe they know that this has occurred. So we think this stock has some nice upside just based on that news filtering out and the fact that this could be an approved drug in Europe sometime in the middle or late part of next year, and then also be filed in the U.S. next year as well to get approved. So if the risk of this company is if they have to do a longer trial, so they only did roughly 75 patients. If they have to do multiple hundreds of patients to get approved, they have the cash to do it. So we think that's the risk. It's probably mostly in the stock if that's the case. And if it's not in the stock, we've got a big, big winner here. So thank you very much. Remember, we're in a tough period of time. We really like the smaller cap stocks. If there's a buying opportunity, we like growth and income. We like higher dividend paying stocks. We don't like the market in general. We think you have to be protective around your money. Take care. Happy Halloween, and come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute. And remember, hit like.